Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 5th of February. I'm Daniel Lam, your host for the podcast. After the Fed meeting last week, the non-farm payroll report reinforced the message that a March rate cut is not the base case scenario. The 353,000 increase in non-farm payroll employment easily beat expectations of a slowdown to 185,000. The improvement was broad-based across industries such as healthcare, manufacturing, and retail sales. They all experienced an acceleration in job gains last month. Meanwhile, the increase in the prior 2 months was revised up by 126,000, bringing the December increase to 333,000. The unemployment rate was unchanged at 3.7%, while average hourly earnings accelerated on both a month-over-month and year-over-year basis. Now, the U.S. Economic Surprise Index has been surging this year, indicating that economic conditions are firm. In particular, manufacturing PMIs delivered a positive signal last week, with activity expanding for the first time in 9 months. And although the ISM manufacturing PMI remains below the 50 boom-bust line, its 2-point increase pushed it to its highest level since October 2022. So this is actually giving rise to a no-landing narrative in the US economy. And that explains why, during the FOMC press conference last week, Powell said that the greater risk is that inflation would stabilize at a level meaningfully above 2%. And that these risks are why policymakers are keeping their options open and not rushing to cut rates. So we saw that immediately after FOMC, we have the US 10-year government bond yield coming off, i.e. bonds rising in price, and S&P 500 selling off. But after the jobs report, we have exactly the opposite, with the 10-year bond yield rising sharply by 20 bips and going above the key level at 4%. Meanwhile, S&P 500 goes above its all-time high. So going forward, investors need to acknowledge the strength in the US economy, but they would also need to watch out for signs of overheating in the US economy. So you want to be exposed to high-quality, resilient growth. Differentiation is the buzzword here. So within the US growth sectors, the earnings season is pointing towards differences across the sub-industries, with continued strength in areas such as semiconductors and cloud, and investors for growth stocks should be focusing on those. While there has been some strong showing in healthcare stocks as well, a sector that we are overweight in our barbell approach. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.